Good day everyone, this is Angel John Garcia Anchata, together with Marilyn Cesar, Sheila May Duman, and Rina Jane Jaime. We are here to present to you the chapter 29 to 32.
Good day everyone, I am Sheila May Duman and I'm going to report about chapter 29, Individual Investor Portfolios. Individual Investor Portfolios. Modern portfolio theory is based on Markowitz's 1952 premise that an investor's purpose is characterized by the anticipated utility function. This assumption has significant normative consequences for optimum portfolios, with two major outcomes sticking out. The portfolio separation theorem claims that all investors choose the same, well-diversified risky portfolio, and the total optimum portfolio between this risky portfolio and the whole optimal portfolio. According to the investor's risk tolerance, a risk-free asset, the second consequence is that, regardless of risk aversion, an investor should always keep some investment in the optimum risky portfolio, as long as the projected risk premium is positive. An individual investor portfolio is a collection of investment owned by an individual for the purpose of achieving financial goals, such as capital appreciation, income generation, or a combination of both. A portfolio may include a variety of asset classes, including stocks, bonds, real estate, commodities, and alternative investments. The composition of an individual investor portfolio depends on factors such as the investor's age, risk tolerance, investment objectives, and financial circumstances. Younger investor with a longer investment horizon and a higher risk tolerance may invest a greater portion of their portfolio in stocks, while older investors with a shorter investment horizon and a lower risk tolerance may prefer a greater allocation to bonds. Diversification is an important aspect of constructing an individual investor portfolio, as it can help to reduce risk by spreading investments across multiple asset classes and sectors. Additionally, individual investors may use a variety of investment strategies, such as value investing, growth investing, and income investing to achieve their financial goals. It is important for individual investors to regularly review and adjust their portfolios to ensure that they remain aligned with their investment objectives and risk tolerance. This may involve rebalancing the portfolio to maintain the desired asset allocation or making changes to the portfolio based on changing market conditions or individual circumstances. Stock market participation and portfolio diversification. Empirical evidence. Limited stock market involvement and equity portfolio under diversification are among the most typical patterns found in individual portfolios. Many individuals can invest in the stock market using low-cost financial instruments. Diversification should be available to even the most inexperienced investors. Empirical evidence supports the idea that participation in the stock market and portfolio diversification can provide benefits for individual investors. Several studies have found that investing in the stock market can lead to higher returns over the long term compared to other asset classes such as bonds or cash. For example, study by Ibbotson and Sinquefield 2011 found that from 1926 to 2010, the average annual return for stocks in the United States was 9.8% compared to 5.5% for bonds and 3.7% for cash. However, investing solely in stock can be risky, as stock prices can be volatile and individual stock can experience significant declines in value. This is where portfolio diversification comes in, as it can help to reduce the overall risk of portfolio by spreading investment across multiple asset classes and sectors. Empirical studies have found that portfolio diversification can lead to improved risk-adjusted returns. For example, a study by Britson, Hood, and Bauer 1986 found that asset allocation, example, portfolio diversification, accounted for over 90% of the variation in portfolio returns among institutional investors. Furthermore, studies have found that individual investors who diversify their portfolios tend to achieve better long-term results compared to those who do not. Another example is that a study by Barber and Odean 2001 found that individual investors who traded less frequently and held more diversified portfolios tended to achieve better returns over a 5-year period compared to those who traded more frequently and held less diversified portfolios. In summary, empirical evidence suggests that participation in the stock market and portfolio diversification can provide benefit for individual investors, including higher returns and reduced risk. How large are the observed inefficiencies in portfolio diversification? Using the standard portfolio model, this section estimates the inefficiency of diversification. The amount of deviation is measured using two dimensions. First, mean variance analysis is used to calculate the confidence equivalent loss caused by portfolio inefficiency and to analyze how this loss is spread among households. Second, deviations from rational belief assumptions are evaluated, which may result in the observed portfolio allocations. The research demonstrates major portfolio inefficiencies from the standpoint of the traditional model as well as significant. In order to promote inefficient portfolio allocation, biases must be present. Based on this approach and current empirical evidence, the conclusion is that investment errors owing to ignorance or prejudice are unlikely to explain the data's ongoing under-diversification. Mean variance metric. Diversified portfolios are inefficient and have a welfare cost in the normal mean variance setting. Brennan and Torres 1999 demonstrate two simulations that this cost may be enormous and far more than the loss associated with inefficient asset allocation. Mulebrook 2005 further demonstrate that investing in employer shares in 400k plans results in significant portfolio efficiency and welfare losses. Calvet 2007 used Swedish data to evaluate welfare loss. You will discover that the losses range from insignificant to significant, both in terms of percentage loss and absolute cash loss. To quantify the loss from suboptimal diversification, consider an investor who divides wealth between risky assets and a risk-free asset. To maximize the standard mean variance preference, the investors in different curves are given by this formula below, where RCE is the certainty equivalent return, is the coefficient of risk aversion, ER is the expected return on total portfolio, and R2 is the variance of this return. If the investor's risky portfolio R is inefficient and an efficient portfolio D with a higher Sharpe ratio is available, the switch from the optimal portfolio using R to the one using D results in the increase of the certainty equivalent given by this formula below, where R is the observed fraction of the total portfolio invested in the risky portfolio R. R is the standard deviation of the risky portfolio, and SR and SD are the Sharpe ratios of the risky and diversified efficient portfolios respectively. This certainty equivalent loss is given in percentage of the total wealth, but it can also be expressed relative to the equity portion only as using this equation. Note that RCE measures a hypothetical equity fund expense ratio that would be equivalent to the efficiency loss. Investors can use the mean variance metric to construct a portfolio that is optimized for their desired level of risk. By selecting a point on the efficient frontier that corresponds to the desired level of risk, investor can construct a portfolio that maximizes their expected return for the level of risk. While the mean variance metric is a useful tool for portfolio optimization, it does have some limitations. One limitation is that it assumes that investors are risk-averse and only concerned with the first two moments of the distribution of returns. For example, mean and variance. Additionally, the mean variance metric assumes that the return of individual securities are normally distributed, which may not always be the case in reality. Biases and diversification. Several potentially significant psychological issues may result in under-diversified portfolios. Biases owing to familiarity and overconfidence are the most frequently mentioned in conjunction with diversity. Overconfidence bias where investors believe that they have more information or expertise than they actually do. This can lead to under-diversification where investors concentrate their portfolios in few stock or asset classes, believing that they have identified the best opportunities for investment. Overconfidence bias can also lead investors to take on too much risk in their portfolios, which familiarity bias where investors prefer to invest in companies or industries that they are familiar with or have personal experience with. This can lead to under-diversification if investors concentrate their portfolios in a few familiar stocks or industries, ignoring other opportunities for diversification. This section measures the degree to which a person should be biased in order to maintain an under-diversified portfolio while assuming expect utility. Let subscript I denote the index and subscript S denotes the under-diversified portfolio stock when writing the unexpected returns or ER and the standard deviations S of the assets Also, let S be the beta of the stock relative to index according to the individual's belief. The utility function of the investor is assumed to be given by a second-order approximation to a generally expected utility as, for example, in Cross and Litzenberger 1976. When ERP and P are the expected return and the standard deviation of return of the portfolio, PNU is a strictly increasing and twice differentiable utility function. Denote the fraction invested into market index as. Then since the expected returns are the same from the stock and index, the first order condition is given by this equation. Assuming U and ERP is not equal to 0, we can express the optimal fraction invested in the index as this equation. Note from the above formula that to achieve a non-zero allocation to stock, the investor must believe S is greater than 1 regardless of the value of the variance ratio V. This contradicts single index CAPM, which implies that S equals 1 because the expected returns of stock and index are assumed to be equal. When 0.5, the bias in beta can be expressed as follows this equation. Identify this bias, suppose that the investor reasonably estimated that by this formula below. Then to achieve 20% allocation to stock and 80% to index, the investor must believe that BS is equal to 0 and all risk premium of the stock is due to alpha. Even if the investor believes that the stock is not significantly riskier than the index, say V is equal to 2, the required beta for the same allocation is still substantially biased at 2/3, implying that 1/3 of the risk premium of the stock is due to alpha. As a result of investor biases and ignorance or mistakes, there are significant issues with the interpretation of portfolio diversity. First, the biases and mistakes would have to be exceedingly persistent rather than being reduced over time via learning. This is especially puzzling during stock market downturns when the dangers of under-diversification are highlighted. Biases may play a key part in increasing direct stock holding during market upturns, but some investors stay impressively loyal to under-diversification regardless of stock market phases. Second, if biases are caused by a miscalculation of risk, they fail to explain why highly educated and wealthy investors scale down but do not totally eliminate under-diversified components of their portfolios, according to Polkov-Nichenko 2005. Furthermore, as demonstrated by Calvet 2007 for Swedish data and Polkov-Nichenko for SCF data, aggressiveness is related to demographic characteristics such as household size, entrepreneurial status, and readiness to take financial risks. If it is the consequence of errors, the reasoning is unclear. Instead, under-diversified investors are making a deliberate and educated decision to bet on large but improbable returns. Rank-dependent preferences and portfolio choice. Rank-dependent preferences are a type of decision-making framework in which individuals evaluate prospects not only based on their respective values but also based on how they are ranked relative to other prospects. In other words, given individual assign more or less value to a prospect depending on its rank in a given set of prospects. This section examines rank-dependent preferences and demonstrates how portfolio choice suggested by these utilities might result in under-diversification and stock market non-participation. The rank-dependent expected utility RDEU, Kingi 1982 and Yaari 1987, and cumulated prospective CPT, Tversky and Kahneman 1992 models are employed here. Nonlinear decision weighting is used by both utilities. CPT provides the difference between loss and gain outcomes to functions. Consider first the RDEU, a simpler model with a structure similar to expected utility. Let I equals to 1 continuously n. Index possibly well outcomes I ordered from lowest to highest. Every outcome is assigned to decision weight I. The RDEU function is given by this equation, where U is the outcome utility. The simulations below use power utility. The decision weights WI are constructed using a strictly increasing function, defined on the cumulative probability of outcomes pi as follows by this formula. P is equal P. RDEU coincides with expected utility. The shape of Q determines individual risk attitude and experimental evidence points to an inverse S-shape in function. For example, Tversky and Kahneman 1992 and Wu and Gonzalez 1996 used the following specification. This weighing functions overweights the outcomes in the tails of the distribution relative to their objective probabilities. This implies risk-averse behavior with respect to unfavorable outcomes, while simultaneously making more desirable the outcomes with high but unlikely payoffs. To see this more readily, note that the decision weight can be expressed as this by the formula below, where pi is the objective probability of event I. Thus, if q pi is greater than 1, the decision weight exceeds the objective probability and vice versa. For the inverse S-shaped weighing function, the derivative is higher than 1 in the tails of the distribution. The above weighing function is used in the CPT model, but with an additional distinction for gains and losses. Prospect theory assumes that value function depends on gain or loss. X is equals to W minus 0, relatively to a preference point 0, where captures losses aversion, that is the tendency to emphasize losses more than gains. In the simulations, the reference point is selected to be equal to the initial WEP increase by the risk-free return. The assumption about the reference point is important for CPT. As discussed later, Tversky and Kahneman 1992 estimated the parameters for this value function to be. The term is fixed at its estimated value while varying in weighing function parameters in the simulations below. The combined value function is a weighted average over all possible gains and losses. Weights are defined separately for gains and losses as this equation, where I is the probability of all outcomes at least as good or bad, as I and I is the probability of all outcomes that are strictly better or worse than I. Note that each set of decision weights for gains and losses adds up to 1. The optimal portfolio allocation is computed by simulating log normal return distribution for a stock and an index fund. Assuming a 1-year horizon, the expected log return on the stock and the index is set equal to 8%. A risk-free asset available to the investor is assumed to earn 2%. The index log return standard deviation is set to I equals 18%, and the simulated return is equal to by this formula. The stock return is simulated by adding an idiosyncratic component E to the index return as follows. Both simulations are using the same draw-off. The simulations are computed for the following values of idiosyncratic volatility. End results are reported only for the endpoints of this range. Therefore, for each set of utility parameters, the reported results provide bounds obtained in simulation. In the context of portfolio choice, rank-dependent preferences can have a significant impact on an individual's investment decisions. Specifically, investors may be more inclined to choose investments that are expected to perform well relative to their peers, rather than simply maximizing the expected return or minimizing the risk. For example, an investor may choose to invest in a mutual fund that has outperformed its peers in recent years, even if its expected return is not significantly higher than other funds. This decision may be driven by the investor's desire to achieve a higher rank within the social group or to avoid the negative social consequences of underperforming. Moreover, rank-dependent preferences can also affect how investors react to changes in the performance of their investment. If an investment that was previously ranked highly experienced a drop in performance, investors may be more likely to sell the investment to avoid the negative consequences of holding a lower ranked investment. Conversely, if an investment that was previously ranked low experienced a significant increase in performance, investor may be more likely to buy the investment to improve their rank within their social group. Overall, the impact rank-dependent preferences on portfolio choice is an important area of research for understanding how individuals make investment decisions in the real world.
So I am Angel John Garcia Anchata, and I will be reporting or discussing the chapter 30, which is the cognitive abilities and financial decision. So cognitive abilities can have a significant impact on financial decisions. In general, cognitive abilities refer to a mental process, including attention, memory, perception, problem-solving, and making decisions. These abilities can influence how individuals process information, evaluate risks and rewards, and make choices about their finances. Research has shown that individuals with higher cognitive abilities tend to make better financial decisions. For example, they may be better at understanding financial concepts, managing debts, and avoiding financial scams. They may also be better at making long-term financial plans and managing their investments. On the other hand, individuals with lower cognitive abilities may struggle with financial decision-making. They may have difficulties understanding financial concepts, managing their finances, and making information decisions. This can lead to poor financial outcomes such as accumulating debts and making risky investments. It is important to note, however, that cognitive abilities are just one factor that can influence financial decision-making. Other factors such as emotions, personal values, and social influence can also play a role. It's important for individuals to be aware of their own cognitive abilities and to seek out resources and support to them to make informed financial decisions. Now, moving forward with cognitive abilities and broad financial decisions. Cognitive abilities can affect a wide range of financial decisions, from our day-to-day life, or day-to-day financial management, and long-term investment planning. Some examples of cognitive abilities can impact financial decision-making, including budgeting and financial planning, investment decisions, retirement planning, and of course, avoiding financial scams. For budgeting and financial planning, the ability to organize and prioritize information, think critically, and create effective strategies can help individuals stick to a budget. Help as strong cognitive abilities are often better understanding at financial concept and creating long-term financial plans. Next is investment decisions. People with strong cognitive abilities are often better at understanding investment options, evaluating risk and returns, and making informed decisions. They may also be more likely to seek out professional financial advice. Is retirement planning. Planning for retirement requires individuals to think long-term and make complex financial decisions. People with strong cognitive abilities are often better at evaluating retirement options, estimating future expenses, and creating a plan that will provide financial security in their later years. Fourth is avoiding financial scams. People with strong cognitive abilities may be better at identifying and avoiding financial scams. They may be more skeptical of offers that seems to be good to be true, and better at recognizing warning signs and fraudulent activity. Overall, cognitive abilities may play a significant role in financial decision-making, from basic money management to complex investment planning. It's important for individuals to understand their cognitive strengths and weaknesses and make informed financial decisions. Now, moving forward with, do older investors make better investment decisions? Age alone is not a reliable predictor of decision-making ability. However, there are some factors that tend to improve investment decision-making with age, while others tend to decline. On the positive side, older investors are often more experienced and a longer investment history. This can provide a broader perspective on market trends and cycles, and a better sense of how to weather volatility. Additionally, older investors may have had more time to accumulate wealth, which can give them more secured financial foundations and less pressure to take on high-risk investments. On the negative side, as people age, cognitive abilities can decline. This can impact an individual's ability to process complex information, evaluate risk and rewards, and make quick decisions. Research has shown that cognitive decline can begin as early as age 45 and can progress more rapidly in some individuals. However, it is important to note that not all older investors experience cognitive decline, and not all younger investors have stronger cognitive abilities. Factors such as education level, experience, and personal motivation can also impact investment decision-making ability. Ultimately, investment decision-making ability is a complex issue that depends on a variety of individual factors. Older investors may have some advantages in terms of experience and perspective, but cognitive decline can impact decision-making ability in some cases. It's important for all investors, regardless of the age, to be aware of their own strengths and weaknesses and seek out resources and support to make informed decisions and investments. Next is the positive effect of investment experience. Investment experience can have several positive effects on individuals' investment decision-making ability. And here are some examples. Let's start with improved knowledge. Over time, investors tend to accumulate knowledge about financial market and investment strategies. This can help them make more informed decisions, evaluate risk and rewards, and spot potential opportunities. Second is better risk management. With experience, investors may develop a better understanding of their risk tolerance and how to manage risk in their investment portfolio. They may be better able to assess the risks associated with different investment options and create diverse portfolio that balance risk and rewards. Third is more discipline. Experienced investors may have or often have a more disciplined approach to investing, which can lead them to better outcomes. They may be more patient in investment decisions and avoiding impulsive or emotional reaction to market fluctuations. Fourth one is greater confidence. As investors gain experience, they may become more confident in their ability to make sound investment decisions. This can lead to better decision making and willingness to take a new investment opportunities. Fourth is improved performance. Over the long term, experienced investors may achieve better investment performance. This can be due to a combination of factors, including better decision making, improved risk management, and disciplined investment approach. In summary, investment experience can have a several positive effects on an individual's investment decision-making ability, including improved knowledge, better risk management, greater discipline, greater confidence, and improved performance. Now moving forward with adverse effect of cognitive aging. Cognitive aging can have an adverse effect on individuals' ability to make financial decisions. And here are some. First is reduced memory. As people age, they may experience declines in their working memory capacity, which can make it more difficult to remember and process complex financial information. This can impact an individual's ability to evaluate risk and rewards, as well as their ability to make informed investment decisions. Second is slow processing speed. Cognitive aging can also impact processing speed, making it more difficult to analyze financial information and make decisions quickly. This can lead to missed opportunities and delayed reaction to the market changes. Third is reduced attention. Older individuals may have reduced attention and focus, which can make it harder to keep track of multiple investment options or to stay up to date on market trends. This can make it more difficult to make informed investment decisions. Fourth is increased vulnerability to scams. As people age, they may become more vulnerable to financial scams and fraudulent activities. This can be due to a combination of factors including reduced cognitive ability and increased trust in others. Fourth is risk aversion. Some research suggests that cognitive aging may lead to increased risk aversion as individuals become more focused on preserving their financial resources. This can lead to missed opportunities for growth and can impact long-term financial planning. In summary, cognitive aging can have several adverse effects on an individual's financial decision-making ability, including reduced memory, slower processing speed, reduced attention, increased vulnerability to scams, and increased risk aversion. It's important for individuals to be aware of this potential effect, to seek out of resources, and to help them make informed financial decisions. Abilities, portfolio distortions, and performance. Cognitive abilities can impact investors' portfolio distortions and performance, and here are some examples. First is overconfidence bias. Overconfidence bias can cause investors to overestimate their knowledge and skills, leading to excessive trading, undiverse portfolio, and poor investment choices. It can negatively impact their portfolio performance and increase risk. Second is loss aversion bias. Loss aversion bias can cause investors to hold on to losing investments for too long, leading to underperformance and missed opportunities. This can particularly damaging during market downturns, and investors may be reluctant to selling losing investments. Third is anchoring bias. Anchoring bias can cause investors to rely too heavily on particular piece of information, such as stock's past performance, and fail to consider other important factors when making investment decisions. This can lead to unbalanced portfolio and suboptimal investment choices. Fourth is confirmation bias. Confirmation bias can cause investors to seek information to confirm their existing beliefs, while disregarding information that contradicts them. This can lead to overconfidence and missed opportunities. Fifth is cognitive decline. As the cognitive abilities decline with age, investors may be more poor in making investment decisions. This can lead to portfolio distortion such as over-concentration or excessive risk-taking, which can negatively impact performance. To mitigate the impact of cognitive biases and cognitive decline on portfolio distortions and performance, investors can employ strategies such as diversification,
disciplined investing, regular portfolio reviews, and seeking out advice from financial professionals. Additionally, staying informed and up to date on the market trends and investment options can help investors make informed decisions and avoid common biases. An empirical model of cognitive abilities. An empirical model of cognitive abilities can be used to study the relationship between cognitive abilities and financial decision making. Such models typically involve collecting data from a sample of individuals and measuring their cognitive abilities using standardized tests or assessments. The data can then be used to explore the relationship between cognitive abilities and financial decision making in various contexts, such as investment choices, risk tolerance, and financial literacy. Some examples of empirical model that been used to study the relationship between cognitive abilities and financial decision making includes: first is the behavioral life cycle model, which this model focuses on how cognitive abilities and personality traits evolve over a person's life and how they influence financial decision making. The model suggests that people's financial behavior is influenced by their cognitive and emotional development at different stages of life. Second is the prospect theory model. This model explores how cognitive biases and heuristics affect financial decision making. The model suggests that people's decision making is influenced by how they perceive gains and losses, as well as by their aversions to risk. Next is the rational expectation model. This model assumes that people make rational financial decisions based on all the available information. However, the model recognizes that the cognitive limitations and biases can impact decision making and lead to suboptimal outcomes. Overall, empirical model and cognitive ability of cognitive abilities can provide insight to factors that influence financial decision making and help individuals to make more informed decisions. By understanding the relationship between cognitive abilities and financial behavior, individuals can make better choices and achieve their long-term financial goals. Abilities in the three puzzles. Cognitive abilities have found to play a significant role in solving the three puzzles of finance, which are the equity premium puzzle, the risk-free rate puzzle, and the volatility puzzle. And here's how. First is the equity premium puzzle. The equity premium puzzle refers to the difference between the expected return on stocks and the risk-free rate, which is much higher than what can be explained by rational financial models. Some research suggests that the puzzle may be due to individuals having different perceptions of risk and returns, which could be influenced by their cognitive abilities. For example, is the individuals who are overconfident may be more likely to invest in stocks, leading to higher returns, but also higher risk. Next is the risk-free rate. It's the risk-free rate puzzle. The risk-free rate puzzle refers to the observation that the risk-free rate is often lower than what can be explained by the rational financial models. One potential explanation for this puzzle is that the individual may have different expectation of future inflation, which could be influenced by their cognitive abilities. For example, individuals with higher cognitive abilities may be better able to process and interpret economic information, leading to more accurate inflation expectations. Next is the volatility puzzle. The volatility puzzle refers to the observation that assets prices are more volatile than what can be explained by the rational financial models. Some researchers suggest that this puzzle may be due to the fact that individuals have different perception of market risk, which could be influenced by their cognitive abilities. For example, individuals who are more risk adverse may be more likely to react strongly to the market volatility, leading to higher level of volatility overall. Overall, cognitive abilities are an important factor to consider when trying to understand or solve the three puzzle of finance. By taking into account how cognitive abilities influence financial decision making, researchers and investors can gain a better understanding of underlying causes of this puzzle and make more informed investment decisions.
Good day everyone, let me introduce myself to you. I am Marilyn Cesar and I will be discussing the topic covered by Chapter 31, Pension Participant Behavior. And before I tackle the topics under this chapter, may I give you an overview of what pension participant behavior is. Pension participant behavior is an important topic in the field of behavioral finance. The decisions that pension participants make regarding their contributions, investment choices, and the withdrawal decisions can have a significant impact on their retirement income. So here are some examples of how behavioral finance concepts can apply to pension participant behavior. So number 1 is default options. Default options can have a significant impact on pension participant behavior. For example, if the default contribution rate is set too low, many participants may not contribute enough to meet their retirement goals. Similarly, if the default investment options is too conservative, participants may miss out on potential investment returns. By understanding how default options can influence participant behavior, pension plan sponsors can design defaults that encourage positive outcomes. So number 2 is decision-making biases. Decision-making biases can also play a role in the pension participant behavior. For example, individuals may exhibit present bias, meaning that they place too much emphasis on short-term gains rather than long-term goals. This can lead to inadequate retirement savings. Similarly, individuals may exhibit status quo bias, meaning that they are reluctant to many changes to their investment or contribution rates. This can lead to suboptimal investment choices and lower retirement income. Third and the last one is financial education. Providing financial education to pension plan participants can help mitigate the impact of decision-making biases and encourage positive behavior. Education can help participants better understand the risks and benefits of different investment options, as well as the importance of saving for retirement. By empowering participants to make informed decisions, they may be more likely to achieve their retirement goals. So overall, understanding the behavioral biases that can affect pension participant decision-making is crucial for designing effective pension plans that can lead to positive retirement outcomes. By options, pension plans can help participants make informed decisions and achieve long-term financial security. So now, let's move on to the topics under pension participant behavior. The first one would be the participant decision. The participant decision is a critical first step for individuals when it comes to saving for retirement. It refers to the decision to enroll in a retirement savings plan, such as 401k, IRA, or individual retirement accounts, or pension plan. So there are several factors that can influence an individual's participation decision, and this includes 1. Availability of the plan. The availability of a retirement savings plan can have a significant impact on participation rates. If an employer does not offer a retirement plan, employees may be less likely to save for retirement. Number 2, plan design. The design of the retirement savings plan can also influence participant rates. For example, plans with automatic enrollment or employer matching contributions may be more attractive to employees and lead to higher participation rates. So third is demographic factors. Demographic factors such as age, income, and education can also play a role in the participation decision. For example, younger employees may be less likely to participate in retirement plan than older employees, while those with higher incomes may be more likely to participate. Last is behavioral factors. Behavioral factors such as decision-making biases and social norms can also impact the participation decision. For examples, individuals may exhibit a status quo bias, meaning that they are more likely to stick with the default options, such as not enrolling in the plan, even if it is not in their best interest. So overall, the participation decision is a critical factor in determining an individual's ability to save for retirement. By understanding the factors that influence participation rates and taking steps to encourage participation, employers can help employees achieve their retirement goals and secure their financial futures. Next in line is the contribution levels. Contribution levels refer to the amount of money that an individual contributes to a retirement savings plan, such as 401k, IRA, or pension plan. Contribution levels are an important factor in determining an individual's ability to save for retirement and achieve their long-term financial goals. Investors can be divided into 4 categories based on their contribution levels. 1 is passive contributors. These are the investors who make very little effort to manage their investments. They may invest in mutual funds or other passive investment vehicles and rarely make changes to their portfolio. Second is active contributors. These investors are more engaged than passive contributors and actively manage their investments. They may research investment opportunities and regularly make changes to their portfolio. Third is the proactive investors. These investors are highly engaged and take a proactive approach to managing their investments. They may have a higher degree of knowledge about markets and may actively seek out investment opportunities. Lastly, the obsessive contributors. These investors are extremely engaged and may be obsessed with investing. They may spend an excessive amount of time researching investments and may take significant risks in pursuit of higher returns. So Ken Baker and Singer also stated that investors may move between these categories over time, and that contribution levels may also vary based on the investor's age, wealth, and investment goals. So understanding an investor's contribution level can help financial advisors tailor their advice and recommendations to meet their investors' needs and preferences. Next topic would be asset allocation decisions. Asset allocation decisions refer to the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, and cash, in order to achieve a specific investment objective while taking into account the investor's risk tolerance, time horizon, and financial goals. The asset allocation decision is a critical component of portfolio management and can have a significant impact on an investor's long-term investment returns. So there are several factors that can influence an investor's asset allocation decision, and these include, first, risk tolerance. An investor's risk tolerance is one of the most significant factors in determining asset allocation. This approach considers the investor's risk tolerance, which is the degree of risk they are willing to accept to achieve their financial goals. And investors with a high risk tolerance may prefer to allocate more of their portfolio to riskier assets such as stocks, which have higher potential returns but also higher risk, while other investors with a low risk tolerance may prefer to invest more in bonds or other fixed income investments, which have lower potential returns but also lower risk. Second factor would be investment goals. An investor's investment goals can also influence asset allocation decisions. For example, investors with longer time horizons may have more time to ride out market fluctuations and may be more willing to take on greater risk for potentially higher returns, while investors with shorter time horizons may prioritize preserving their capital and avoiding significant losses. Additionally, an investor's specific financial goals, such as saving for retirement or funding child's education, can also play a role in determining their asset allocation strategy. Third one is the market conditions. Market conditions such as interest rates, inflation, and economic growth can also impact asset allocation decisions. Inflation erodes the purchasing power of cash and fixed income investments, so investors may increase their allocation to assets that can potentially provide a hedge against inflations, such as stocks and commodities. In addition, during periods of low interest rates, investors may also allocate a larger portion of their portfolio to stocks and other higher risk assets, as fixed income investments may provide lower yields. On the other hand, during periods of economic uncertainty, investors may allocate a larger portion of their portfolio to less risky assets such as bonds and cash. Economic growth can also impact asset allocation decisions, as stronger economic growth may lead to higher stock returns, while weaker economic growth may lead investors to allocate more of their portfolio to bonds and other fixed income investments. The last one would be tax consideration. Tax considerations are a significant factor to consider when making asset allocation decisions. Investors may choose to allocate a larger portion of their portfolio to tax-advantaged accounts, such as individual retirement accounts, RRAs, or 401ks, to minimize taxes on investment returns. Additionally, they may choose to invest in tax-efficient assets, such as index funds, to minimize taxes on capital gains and dividends. On the other hand, investors may choose to hold tax-inefficient assets, such as bonds or actively managed funds, in tax-advantaged accounts to minimize the tax impact on their overall portfolio. Here are some strategies that investors can use to make effective asset allocation decisions. First, diversification. Diversification is a crucial strategy for making effective asset allocation decisions. It involves investing in a variety of asset classes, such as stocks, bonds, real estate, and commodities, to help reduce portfolio risk. By diversifying their investments, investors can reduce their exposure to any single asset or market segment and spread their risk across multiple areas. This can help protect against losses during market downturns and potentially increase returns over the long term. Second is rebalancing. Rebalancing involves periodically adjusting portfolio holdings to maintain the desired asset allocation. Over time, as different asset classes perform differently, the original allocation can become unbalanced, resulting in higher risk or lower returns than intended. So rebalancing can help to bring portfolio back in line with the desired allocation and can potentially enhance returns while reducing risk. The third and the last one is asset allocation models. Asset allocation models are predetermined investment strategies that are designed to help investors achieve their investment goals by balancing risk and return. Asset allocation models, such as target date funds or risk-based models, can provide a simple and effective way for investors to achieve their desired risk and return profile. Overall, asset allocation decisions are a critical component of portfolio management and can have a significant impact on investment returns. By understanding the factors that influence asset allocation decisions and using effective strategies to implement their investment goals, investors can achieve their long-term financial objectives. So for the last topic, let me discuss with you what is trading. The concept of trading on finance and investing generally refers to the buying and selling of financial assets, such as stocks, bonds, commodities, or currencies with the aim of generating profit. Kent Baker's work focuses on the various factors that can influence trading behavior and decision-making, including market volatility, investor sentiment, and psychological biases. He examines the ways in which traders attempt to forecast market movements and make informed investment decisions and explore the strategies that successful traders use to manage risk and maximize returns. Trading behavior in 401k plans is characterized by extreme inertia, meaning that investors trade infrequently even in times of market turmoil. This behavior is consistent with the implications of optimal portfolio choice models with realistic transaction cost. However, this inertia can be a concern if it results from procrastinations and lead to investors being defaulted into funds that are inappropriate for risk characteristics. In addition, a very small subset of investors may be reacting to market returns, which can lead to positive feedback trading. Access to the internet can increase trading frequency but does not necessarily lead to higher risk-adjusted returns. So plan sponsors have introduced life cycle funds and managed account services to encourage passive rebalancing and improve investment outcomes. Ken Baker also emphasizes the importance of disciplined trading practices, such as maintaining a diversified portfolio, setting clear investment goals, and sticking to a long-term investment strategy. Overall, Baker argues that traders must be aware of their own biases and work to compensate them in order to make better investment decisions. So that is all for my discussion. Let me introduce to you Rina Jane Jaime to introduce and discuss Chapter 32, The Institutional Investor.
Hello everyone, I am Rina Jane S. Jaime and I am going to report the Chapter 32, Institutional Investor. So let me tell you about this chapter. This chapter discusses the literature on institutional investors. First, it selectively surveyed the vast literature on whether institutional investment managers, specifically hedge funds and mutual funds, deliver superior risk-adjusted return to their outside investor. So early work was skeptical about the ability of investment managers to deliver alpha. But the use of new econometric techniques and the advent of hedge funds have resulted in new evidence that some investment managers can deliver consistently positive risk-adjusted performance. Next on this chapter, it will discuss the literature that analyzes the holdings and trades of institutional investors of both low and high frequency. Evidence suggests that institutions are well informed about cash flow, relevant news, and trade consistently in the right direction before and after earnings announcement. Lastly, it will also discuss the restriction on institutional investor imposed by the behavior of capital flows from outside investors and the incentives that the institution to worsen rather than correct and mispricing in their asset markets. The empirical work on institutional investors. There has been a significant amount of empirical work conducted on institutional investors, particularly in the fields of finance and economics. And some of the key findings includes, first, institutionalized investors tend to be more rational and have longer investment horizon than the individual investors. So this can be a result in more efficient pricing of their asset and improved allocation of their capital. Second, the institutional investor can have a significant impact on the behavior of firms in which they invest. For example, they may engage in shareholder activism to push for changes in their corporate governance or other strategic decisions. Number 3, there is evidence to suggest that the institutional investors tend to prefer larger and more established firms with strong financial performance and lower levels of risk. Number 4, institutional investors tend to hold more diversified portfolios than the individual investors, which can clearly help to reduce overall portfolio risk. And lastly, there are some debate about whether institutional investors can really contribute to the market volatility or stability. Some studies suggest that their trading activity can worsen short-term price movements, while others suggest that their longer-term focus can help to stabilize markets. So overall, the empirical research on institutional investors highlight their important role in financial markets and the economy more broadly. The returns of institutional investment managers, the mutual funds. This section examines mutual funds returns. So first, let's define what is mutual funds. So basically, mutual funds are investment vehicles that pool money from various investors to invest in a diversified portfolio of stocks, bonds, and other securities. So the institutional investment managers, such as mutual funds managers, are responsible for managing the investment within these funds. The return of mutual funds are dependent on various factors such as the skill of the investment managers, the investment strategy employed, the economic condition, and the performance of the underlying securities in the portfolio. So there are several studies that have shown that on average, the mutual funds manager do not outperform the market in the long term. This is partly due to the fees associated within mutual funds, which can eat into investment returns. However, some mutual funds do outperform the market, and the investor can find them by carefully researching and selecting funds based on their investment strategies, fees, and past performances. So it is important to note that the past performances is not guarantee of future results, and investors should consider their own investment goals and risk tolerance before investing in the mutual funds. Additionally, investors should always read the fund's prospectus and understand the fees, expenses, and risks associated within the fund before they invest. The next topic is the returns of institutional investment managers, the hedge funds. So this section examines hedge funds returns. So what is hedge funds? So hedge funds are relatively new form of investment management vehicle. It is a full money for investor and invest in securities or other types of investment with the goal of getting positive returns. So there are some key factors that influence the returns of hedge funds. First is the investment strategy. Hedge funds use a wide range of investment strategies, including long or short equity, event-driven, global macro, and relative value. The success of these strategies can vary depending on market conditions and the skill of the investment manager. Number 2 is the market conditions. Hedge funds are often more active in the market and take on more risk than the traditional investment vehicles. So as a result of this, the returns can be more volatile and subject to fluctuations based on changes in the market conditions. Number 3, fees. Hedge funds typically charge high fees, including a management fee and a performance fee, which can significantly impact investor returns. Fourth, the risk management. So the effective risk management is crucial to the success of hedge funds. An investment manager must be able to identify and manage risk effectively to avoid large losses. Last factor is the investment team. The quality of the investment team can also play a significant role in success of a hedge fund. Experienced investment professionals with a strong track record can help to generate strong returns for investors. Overall, the returns of institutional investment managers such as hedge funds can vary widely depending on this and other factors. While some hedge funds have generated exceptional returns for investors, others have struggled to deliver consistent performance over time. As with any investment, it is important for investors to carefully evaluate the track record and investment strategy of a hedge fund before investing. The holdings and trades of institutional investment managers, low-frequency data. This section analyzes institutional investors' holdings. The analysis of mutual fund returns, while useful, does not provide much information about funds' ability in the event that managers consume the rents that they generated in the forms of fees. So, what is low-frequency data? So, it refers to the data that is reported at infrequent intervals, typically quarterly or annually. Institutional investment managers typically report their holdings and trades on a quarterly basis through a regulatory filing called Form 13F. This form requires managers to disclose their long equity holdings, option holdings, and convertible debt holdings, as well as the number of shares traded during the reporting period. Although the data reported on Form 13F is only released on a quarterly basis, it is still a valuable source of information for investors and analysts. So, the data can be used to track the investment strategies of institutional investment managers and identify trends in the market. However, it is important to note that Form 13F only requires disclosure of long equity holdings, which means that the short positions are not reported. Additionally, the reporting threshold for Form 13F is $100 million in asset under management, so smaller managers may not be required to disclose their holdings. So finally, there is a lag between the end of a reporting period and when the data is released, which can be several weeks. But despite these limitations, the holdings and trade data reported by institutional investment managers on Form 13F can still provide valuable insight into the behavior of institutional investors and their impact on the market. Next topic is the holdings and trades of institutional investment managers, the higher frequency data. The institutional investment managers are entities that manage portfolios of securities on behalf of institutional clients, such as pension funds, endowments, and insurance companies. These investment managers have access to vast amount of financial data and often use complex algorithms to analyze this data and make investment decisions. So what is a higher frequency data? So it is a one type of data that institutional investment manager may use in their analysis. And it is refers to a financial data that is updated more frequently than daily, such as tick data. So tick data is the data that records every transaction or minute by minute price data. So this type of data can provide more granular insight into market behavior and can help investment managers make more informed investment decisions. So there are several ways in which institutional investment managers may use higher frequency data in their holdings and trades. And one common approach of this is to use this data to identify short-term market trends or anomalies. So for an example, if an investment manager noticed that a particular stock is experiencing a surge in trading volume, they can use this information to make a short-term trading decision. Another way in which investment managers can use this higher frequency data is to monitor the performance of their existing holdings by analyzing minute by minute price data. So the investment manager can quickly identify whether a particular stock or a portfolio is performing as expected and making an adjustment is necessary. Another thing is they can use this data to track the performances of their competitors. So by analyzing the trades and holdings of other investment managers in real time, so they can gain insights into market trends and adjust their own strategies accordingly. So overall, the higher frequency data can be a valuable tool for institutional investment managers that are looking to make informed investment decisions. However, it is important to note that this type of data can be complex and difficult to analyze, and investment managers must have a necessary expertise and resources to effectively use this. Now let's talk about the capital flows to institutional investors. Scholars have studied the behavior of capital flows to institutional investors in great detail, so let's define these two important words. Capital flows to institutional behaviors refers to the movement of funds from various sources to investment firms, such as pension funds, insurance company, and mutual funds for the purpose of investment. On the other hand, institutional investors play a significant role in financial markets as they manage large sums of money on behalf of their clients or members, and their investment decisions can influence asset prices and market trends. Capital flows to institutional investors can come from a variety of sources, including pension funds. So, it is a retirement plan sponsored by employers, unions, or government entities that invest the contribution made by the employees to generate returns and provide retirement benefits. Next is insurance companies. These are companies that offer insurance policies to individuals and businesses and invest the premiums collected to generate returns and meet their obligation to policyholders. Number 3 is the mutual funds. So, like what I said earlier, this is the investment vehicle that pool money from multiple investors and invest in a diversified portfolio of assets, stock, bonds, and other commodities. Lastly, the sovereign wealth funds. So these are state-owned investment funds that invest in various assets to generate returns and support their country's economic development. So these factors that influence capital flows to institutional investors include economic condition, market trends, investor sentiment, and government policies. For examples, in time of economic uncertainty or low interest rate, investor may allocate more funds to institutional investor to achieve higher returns. On the other hand, changes in government regulation or tax policies can affect the demand for institutional investment products and the amount of capital flowing to them. So now we have a question here. Do institutional investors always behave responsibly? Institutional investors in aggregate are a driving force behind firms' performance around the world. They are often called market makers. So the institutional investor exerts a large influence on the price dynamics of different financial instruments. The institutional investors, like any other type of investors, are motivated by the goal of maximizing returns on their investments. While institutional investors are often subject to regulatory requirements and have this obligation to their clients, they may not always behave responsibly. Because there have been some instances where institutional investors have engaged in unethical or irresponsible behavior, such as insider trading, market manipulation, and fraudulent activities. For example, in 2008 financial crisis, several institutional investors were found to be engaged in risky behavior, such as investing in subprime mortgages, which ultimately lead to significant losses. However, it's worth noting that most institutional investors operate within legal and ethical frameworks and take their responsibilities seriously. Institutional investors such as pension funds and endowments often have long-term investment horizon and a focus on sustainable investing, which prioritize investment that has a positive environment, social, and governance impacts. Ultimately, the behavior of institutional investors depends on a range of factors, including the regulatory environment, the investment objectives of their clients, and the overall culture of the organization. While institutional investors may not always behave responsibly, there are mechanisms in place to hold them accountable for their action, including legal and regulatory oversight and public scrutiny. So there are some expectations that have been driven not only by growing visibility and urgency around many issues, but also by a better understanding of investors' behavior role in shaping real-world outcomes and their responsibility to do so across all their investment activities. That would be the end of our group report covering from Chapter 29 to Chapter 32. Thank you, Sir Al, and thank you, classmate, for listening. I hope you learned something from us. Thank you!